So are you someone that wants to buy and start investing in residential real estate, either 1 to 4 units, or maybe even up to 5 to 10 units, and don't know where to start? Or you already own some properties and you do not have a steady personal income stream, then this loan product is right for you, and it's called the DSCR loan. And in today's video, we're going to go over the pros and the cons of using a DSCR loan so that you can see if this is going to be a right fit for you. Now let's get into it. So first off, what is a DSCR loan? So the whole purpose of this loan is it's to buy an investment property, and you're using the rental income for that specific property to qualify, not your personal income. So the property itself must qualify as long as the rental income at the very least covers the mortgage payment. And here's the formulas that the banks use to determine if this will work or not. Is they're going to take the rental income for that property, divide it by the mortgage payment, which that needs to include everything, property taxes, insurance, HOA out the door, and that gives them a ratio. So for example, let's say the rental income for the property is $200 a month and the mortgage payment is lower than that, it's $2,200. You divide that, that gives you a DSCR ratio of about 1.9, and anything above 1 means that the property is going to cash flow and the bank is going to lend that on that property using this type of loan. So here's the first advantage and pro of using this type of loan, and its personal income does not matter. And in fact, the banks do not need any personal income docs throughout this loan. They're not going to look at your tax returns. They're not going to request any W-2s, pay stubs, any employment verification at all. So this really helps those that are self-employed investors, real estate investors, those with business owners with very complicated tax returns that might be writing off a lot of income, or they have a lot of expenses. And the second pro is going to be there's no limit on the number of properties that you can have financed at one time. Because when it comes to conventional loans, normally the banks only allow you to finance up to 10 properties at a time. And with DSCR loans, again, there's no official limit. You can have 11 properties, you can have 25 properties, you can have 50 properties financed at one time, and they do not cap you at a certain amount, which really helps investors able to scale faster. And the third advantage is they're very flexible when it comes to property types. So eligible properties are single family homes, condo, townhouses, 2 to 4 units. You can even go 5 to 10 units just as long as the rental income covers the mortgage payment. And the condition of the property, it does need to be livable. It cannot have major safety hazards, major issues like that. And actually the appraiser is going to come out into the property and do an inspection of itself. So if it's a property that needs a lot of work or needs more of a fixer-upper, this is probably not going to be the right loan type for that. And the fourth advantage is going to be you can close in an LLC, and you can have the title/deed in the LLC, a business entity, or even your personal name as well. On the other hand, most conventional loans don't allow you to do this up front and can only be done in your personal name. Now, the benefit of this is investors like to use LLCs because it gives them liability protection, it gives them asset protection, and this can also help with tax planning as well. And number 5 is there's less documentation overall, which makes the loan process a lot easier, and with underwriting as well, because again, there's no personal income docs that they're having to verify. There's no employment verification as well. And how it works is they're going to need to pull your credit. They're going to need a credit report. Generally speaking, they need at least a 680 plus credit. Also, minimum down payment is 20% in most cases. So they're going to need to see that you have money in the bank. So they're going to need to see the last 2 months of your bank statements. Then they just need an appraisal report. And then they just need from the appraisal a rent analysis as well. And that's all what they need for this type of loan. And one of the cons to this type of loan is it is a higher interest rate. And DSCR rates are typically about 0.5 point to about 1% higher than going conventional rates. Now, the reason for this is it's a higher risk loan for banks because again, they're not verifying any of your personal income, and investors normally just accept this because again, this loan allows them to scale a lot faster. And the second con is the property must cash flow. So if the rental income is lower than the mortgage payment, then the loan may not qualify. And who determines the rental income? It's going to be the actual appraisal itself. They're going to come out to the property, they're going to look at the market rent in that area and come up with comps for that. Now, in some cases, if the rental income is a little bit lower than the mortgage payment, most banks will still lend on this, but again, you're going to get a little bit higher interest rate because of this. And for example, let's say the rental income comes out to about $1,000 a month and your mortgage payment is about $2,000. Well, that's going to give you a DSCR ratio of about 0.5, and most banks are not going to lend with a rental income that low. And here's why investors love this type of loan, because again, it allows them to scale a lot faster because they're not having to personally qualify for the home itself. The bank is not looking at their income docs. The bank is not looking at the amount of debt that they have. The property itself has to qualify. So this allows a lot more people to build up their portfolio faster than if they had to qualify for each single loan. And if you're planning to buy a house and you want my help with this type of loan product, click on the link in the description, schedule a call, and I'll be in touch.